Kudzai.
Hi, everyone. Thank you for joining us for individual income tax webinar. We're just going to give ourselves about 5 minutes whilst we wait for everyone to join us.
Are you looking for a trusted partner to enhance your organization's internal controls and ensure compliance? Welcome to Brandmore Advisory, where we specialize in internal audit, risk management, governance, and performance management services tailored to your unique business needs. Our team of experts is dedicated to providing comprehensive internal audits that identify inefficiencies and uncover opportunities for improvement. We help you navigate complex risk landscapes, ensuring your organization is prepared for any challenge. With our governance services, we strengthen your decision-making process, promoting transparency and accountability at every level. Our performance management solutions empower your organization to achieve its goals by aligning individual performance with strategic objectives. Join the many organizations that have benefited from our tailored solutions and expert insights. Choose Brandmore Advisory for a brighter, more secure future. Visit our website at www.brandmore.com or contact us at 011-0263-052 to learn more.
Okay, hi everyone. Once again, thank you for joining us. My name is Kudzai Mawaneke, and I'm going to be your host for today. I'm going to be introducing our speaker, Mrs. Tendai Rushesha, who is a senior accountant at Brandmore. She's also a AGSA as well as a registered practitioner. Who are we as Brandmore? We are a dynamic and professional accounting firm based in Midrand. We do have branches in Zimbabwe as well as the UK. We call ourselves accountability partners. As an organization, we live by this daily. The services that we offer, we do have secretarial services where we offer company registration and company amendments. We also offer consulting services where we look at your organizational business processes as well as performance management setup. We also do audit and audit readiness. We also provide internal audit services and payroll services. We look at your human resources as an organization. We also offer tax services where we look at tax disputes and tax opinion for companies as well as individuals. We also look at your accounting services where we provide bookkeeping, management accounts, as well as financial statements. At this point, I'm going to hand it over to our speaker for today, Mrs. Tendai Rushesha.
Okay, all right. So good morning once again, everyone. Today I'll be taking you through a few things that you would need to know with regards to individual tax and individual tax submissions. So on the objective, what are we going to talk about? We'll talk about what is individual income tax, who should pay individual tax, the tax year and assessments, income tax brackets and rates, deductions, some of the deductions and allowances, tax credits and rebates. And we'll also speak slightly about capital gains tax, which is a topic that is on its own that would need to dwell in a different webinar where we speak about capital gains because it's a broad topic that covers a lot. And then we'll also speak about tax planning and avoidance, and then also then we'll conclude the webinar. So to start with, what description best fits you? Are you a business owner, accountant, individual, or other? Okay. Okay, I think everyone is done answering the question, so we can move on to the webinar. Okay. All right. So what is individual income tax? So individual income tax. So individual tax is tax that is levied on a person's income, including salaries, directors' remuneration, and also if you're a sole proprietor, the income that you earn from that type of for that nature of business is taxable. The profits are taxable under your individual capacity if you receive rental income, and also if you have disposed of an asset of a capital nature, then the capital gains on that asset will also be taxable. So a natural person would mean that a person like me, like an actual person, because it's different from a company. So a natural person, when I say a natural person, that's what I'll be referring to us as individuals who are alive and who can breathe and speak. So a natural person has 3 different tax tables applicable. So there's a progressive tax table for natural persons and deceased debtors and special trusts. This is the one that is used to tax all types of income. And then if you have a severance benefit and retirement fund lump sum, okay, if you receive a severance benefit or a retirement fund lump sum, then you'll be taxed as a different tax table. And if you also withdraw from a retirement, there are also different tax tables that are going to be used to calculate the amount of tax that you have to pay over a particular period in time. So who needs to pay tax? Sorry about that. So who needs to, let me just move the ribbon. Okay, who needs to pay for individual income tax? So if you're a South African resident, you're taxed on a South African citizen, sorry, you're taxed on worldwide income. If you're a non-resident, but however, you have been in South Africa through the physical present test, you're also required to pay tax in South Africa. And if you receive income from a source within the Republic of South Africa, if you're a natural person who's ordinarily resident in South Africa, or who is physically present in South Africa for a specified period, you're also considered a resident for tax purposes. So the same tax rates are applicable for both residents and non-residents, because as I have mentioned, that if you're a citizen, you're taxed on worldwide income, and as a non-resident who has met the physical present test, you're also deemed to be have to pay tax in South Africa if you have met the physical presence test requirements, as long as you earn income from a source within the Republic. Okay, so subject to the exclusions listed for taxpayers who are not required to submit tax returns. So in the next slide, I'll indicate when is a taxpayer not obligated to submit a tax return. With gross income, I'll indicate to say when is it that a taxpayer should not submit an income tax return. And then on this slide, I'm basically indicating to say these are the tax thresholds that are there depending on your age. So let's say you're under the age of 65, the certain up to 95,750. If you earn 95,750, it will not be taxable. If you're 65 years and older, but under 75, if you earn income of 148, taxable income of 148,217, then it will also not be taxable. And then if it's 160, if you are 75 years and older, then the taxable income is only limited to 165,689. So in the next slide, that's where I'm going to explain to say, in this particular instance, you're not obligated to submit a tax return. So, so the government, okay, so sorry about that. All right, so this is the slide that I wanted to get to. So if you're a natural person, you may register for for income tax, but then you're not required to submit income tax if you meet one or more of the following criteria. So if your gross income of the natural person, if it consists solely of remuneration other than a lump sum benefit, is referred below, received from one employer, then you're not obligated to submit a tax return. So let's say that you receive remuneration and your remuneration does not exceed 500,000, and also it does not include any taxable allowances or taxable benefits, and also the amount, okay. And also the amount has been correctly subjected to employees' tax. So in short, what I'm trying to say is that if you receive remuneration from your employer and then the remuneration does not exceed 500,000, and also you have already the employer has already been withholding PAYE and you don't have taxable allowances and taxable benefits, you're not obligated to submit a tax return. And also, if you receive South African sourced interest other than interest from a tax-free investment, if it does not exceed 23,800, if you're less than 65 years, and if it does not exceed 34,500, if you're 65 years and older, then if you're only receiving that interest, because that portion of interest that is received from a South African source, it will be exempt from tax. So basically, if you earn interest, that's 23,800 if you're 65 years and younger, and if you earn 34,500 and you're 65 years and older, then it means that you're not obligated. If that's the only income that you earn, you're not obligated to file an income tax return. And then the next one is when you receive dividends that are exempt from normal tax, where the recipient is was a non-resident throughout the 2024 financial year, 2024 year of assessment. And also if you receive if the amounts that you only receive are from a tax-free investment, then you're not obligated to submit an income tax return. Or if you receive only a single lump sum from a pension provident or a pension preservation fund, provident preservation fund, or a retirement annuity fund, then you're not obligated to pay, you're not obligated. Remember, with SARS, there is a tax directive that is there. As soon as there's a lump sum paid, a tax directive is already on your profile, indicating the amount of tax that has already been paid with regards to that lump sum. So those are the particular instances where you're not supposed to, where you're not obligated to file your income tax return. So of those that I have indicated above, it doesn't apply now. Let's say you want to claim any allowable deductions, or let's say you have medical aid expenses that you want to claim, or travel expenses that you also want to claim. So it won't apply. The provisions above where I indicated when you're not obligated to submit a tax return will not apply if you want to claim certain allowances, or if you have a taxable fringe benefit, or if you have received any other amount in respect of services rendered that are outside South Africa. Okay, so the third one now is, let's say in this past few days, SARS has been issuing auto assessments. If you're in agreement with the auto assessment, then the amount will also be, and the declaration reflected on the assessments are complete and correct as at that date, and you believe that the tax return is actually correct, then you should, you can just agree to the assessment and then you submit it. So those are the three instances where you're not supposed to, where you're not obligated to submit a tax return, because as indicated, first, for remuneration, if you're only earning remuneration and it's less than 500,000, the employer has already paid over the PAYE and SARS already has the information. And also, if you receive the South African local interest only, and if you receive interest from a tax-free investment, as I have indicated. Okay, so now with the tax year, for which periods does the year of assessment of an individual run from? So the year of assessment that an individual tax year runs from the first day of March up until the end of February. And then the due date for submitting the income tax returns is dependent on whether you're a provisional taxpayer or not. So currently, if you're not a non-provisional taxpayer, for your 2024 tax year, your tax return is due on the 21st of October. And then if you're a provisional taxpayer, if you're an individual who's a provisional taxpayer, the income tax return is due on the 20th of January 2025. So those are the dates that you need to take note of, especially if you would want to, if your tax return is not filed, and then also if you're obligated to submit a tax return, or if you have any other allowances that you would want to claim from SARS, then you need to take note of the due dates for the submissions. Okay, I have spoken already about the tax year. So individuals are typically required to submit their returns by the end of February of the following year. So the deadline can be extended under certain circumstances. And then SARS reviews SARS assessment. So what happens is that when you submit your income tax return, SARS reviews the income tax return depending on what has been submitted. In different circumstances, SARS can request supporting documentation for everything that has been declared on the income tax return. So let's say you have declared your remuneration. The supporting documentation that you will need to have is your IRP5. That is in the instance that your employer was withholding tax during the year. So that one is obtained from your employer. They give you on an annual basis. And then let's say you have declared interest, you find it on an IT3B. Otherwise, you can just, if it's on a bank statement, it can be highlighted and then it can be submitted to SARS. And then let's say you need to take into account medical credits. These are indicated on the medical tax certificate. And then if you have on the retirement certificates. So those are examples of supporting documentation that you need to have in place for everything that you would have declared with SARS. It needs to have corresponding supporting documentation, because if we don't submit the supporting documentation, depending on how SARS assesses the situation, the amounts may be removed, and SARS can issue a corrected assessment, which is basically what they have verified with the information that they have been furnished with. So the burden still rests on the taxpayer to prove that the amount that is indicated on the tax return is a true reflection of what is actually happening for the different third parties that they will be dealing with. Okay, so we're still on tax year and assessments. So SARS will issue a tax assessment notice to the taxpayer indicating the final tax liability and any refunds due. Okay, so the taxpayer has a specific period, which is 60 days to object. So let's say this, you're in the same situation that I was explaining, to say that SARS, you have submitted your supporting documentation. You have submitted some of your supporting documentation, but you have omitted the supporting documentation, and SARS has reassessed you and they have given you their corrected assessment. You have 60 days to object the assessed tax and also lodge an objection if they disagree with the assessment that you have given them. So you still have room to be able to object to the corrected assessment that is given by SARS, as long as in that time frame you be able to give the required supporting documentation that SARS would need for you to confirm that an amount is actually truly deductible, an amount is truly taxable. Okay. So as I have mentioned earlier, these are the general general tax tables. Not for the retirement or for the lump sum, not for the retirement lump sums or retirement withdrawals. These are for when you earn any other income, like rental income, remuneration, etc. So okay. So this just says from 1 to 237,100, you'll be taxed at 18%, and then it goes and increases. So the higher the taxable income that you have, the more the tax that you will have to pay over a particular period in time. So that is just the summary of this table that is indicated on the screen. And then, so now we move on to tax credits and rebates. So with tax credits, these are amounts that can be deducted directly from the tax payable. And then rebates, these are fixed amounts that can be deducted from tax payable. So in short, what we are saying is that for tax credits, what happens is that if you have a tax credit that applies to you, for example, let's say medical tax credits, if you have one that applies to you, it does not mean that you automatically get a refund. Basically, with credits, how they work, they reduce the amount of tax that you have to pay over a particular period in time. That's why when they are calculated, they are kept at 0, which means that if, let's say, you have calculated, I'm going to show how we calculate the Section 6B medical credit. Let's say it's exceeding, you're moving greater, you're getting more than to the -0, if I can say it that. If I can say it that way, then it means that anything that's going below 0 is not going to be a refund. Basically, it caps every credit to 0. That is what a credit does. It does not necessarily mean that you have a refund. So with rebates, how they work, with a taxpayer, depending on your age, you have a rebate, which is basically reducing the tax liability that you have to pay. So let's say you're less than 65 years old, then you qualify for a primary rebate, which is 17,235. As you are more than 65 years old, between 65 and 75, you qualify both for the secondary and the primary rebate, which means that 17 and 944 will be your rebates. And then if you're also 75 years and older, you qualify for both tertiary, primary, and secondary rebate. So those are the age rebates that are also applicable to a person that help reduce the tax liability. But however, let's say you're already earning remuneration, and these will be taken into account by your employer or the HR department as they are calculating your tax liability on a monthly basis, your PAYE that you pay. Let's say you're a remunerated individual. So with medical tax credits also, we have what we call Section 6A and Section 6B medical tax credits. So Section 6A credit is calculated based on the number of dependents on the medical aid, and then SARS has different non-static rates per each dependent on a medical aid. And then Section 6B credit is calculated based on your age, and it's also based on the taxable income and the medical expenditure that you would have incurred over a particular period of time. So with Section 6A, for the tax year commencing 1 March 2024, the monthly medical tax credit for medical scheme contributions are as follows. So let's say it's just you, the taxpayer, it's 364, and then you add another dependent, like that's 364, and then if you add another dependent, then it's 364 plus 224, including the other dependent. So let's say you have other dependents that are there. It's 364, and then you add the other dependents that are there on the medical aid scheme. Okay, so I'm gonna give an example of how the medical credits work. So let's say you're a taxpayer and you're 44 years old, and then your taxable income is 136,000 during a tax year of assessment, and then your contributions for medical aid are 31,000, and your qualifying medical expenditure is 11,000. So just a point to note, medical credits do not result in you having a refund. It's a credit, like what I have mentioned, that it's kept at 0. Anything below that, it will be forfeited. Let me just go to the next page. So how the Section 6A works, like how we were saying that, let's say you are the medical aid holder, right? And yet, like in this situation where this one does not have any dependents, it's 364 monthly, which is multiplied by 4, which is going to be 4,368. And then Section 6B now. Section 6B is dependent on a lot of factors like your taxable income, your age, and if you have qualifying medical expenditure. So I'm going to try and make the example as simple as possible. Yeah, so how it works is that you have your medical contribution that you would have made, either you and your employer, or if it's you only who's making the contribution. And then you multiply by 4. If you are less than 65 years old, you multiply by 4. And then if you are more than 65 years old, it's multiplied by 3. But however, if you use the formula to calculate, that's the SARS formula to calculate the Section 6B credit. And then you multiply your Section 6A by 4, and then you get 17,000. And then the difference between your medical contribution and the Section 6A credit will give you a subtotal, and then you add your qualifying medical expenditure to get to a total. But however, where I was saying you need to incorporate your taxable income that you're earning over a particular period of time. So it's 7.5% of that taxable income. And then if let's say 7.5 of your taxable income exceeds the total that you would have calculated there, it means you won't have any credit for that period. But however, in this situation now, it's 24,000, which is greater than 10,200, which we have already calculated, which will result in 14,328, and then multiplied by 20%. So the percentages and the percentages, they are dependent on age, because the other one uses 33.3% if you are older, but if you are younger, then it's 7.5 and then 25%, and then yeah. So that's how the medical credit works for Section 6B. It can get a bit technical, but that's when you need a tax professional to be calculating it for you, should you not understand how the amounts are determined and where they come from. Okay. Okay, so I'm going to briefly touch on tax deductions that are available. So deductions, so these are expenses that can be subtracted from your income when you're trying to get to your taxable income. Example of deductions that you can get, they include your retirement contributions, where it's calculated dependent on a formula that is there, because it's kept to a particular formula for retirement contributions, where you have donations, and then the medical one comes in as a credit now, where we calculate it after we have determined the tax liability over a particular period of time. We also have allowances that you can claim, things like your travel allowance, your disability allowances, that you can also take into account when you're determining your taxable income over a particular period of time. So I'm just going to touch slightly on capital gains, because it forms part of how you get to the taxable income of an individual. So capital gains, it's tax payable made on the profit on the sale of assets. So it's calculated by basically deducting your proceeds and your base cost. But however, as I have indicated, that capital gains is a topic that needs to be discussed in detail, which we are going to touch on in the future webinars, because it's not necessarily straightforward to say it's base cost. There are certain costs that need to be taken into account in determining the base cost. And then, so for individuals, they are taxed at 40%, and also they receive 40,000 annual exclusion. And then in your year of death, if you die, that is also being covered when we do deceased estates and estate management. So there's a deceased person, and then there's a deceased estate. So in your year of death, you receive capital gains annual exclusion of 300,000 in the year that you die. So certain personal assets also are exempt from capital gains tax. So we'll dwell on that in detail when we touch capital gains tax as a topic separately. Okay, other examples of deductions, I've spoken about retirement contributions, where you have legal fees, where you received an amount, for restraint of trade. It's also it's also exempt. And then let's say now where we are in an era where most individuals are working from home. So if you're working from home, the home office expenses, they can be used to reduce the amount of tax that you have to pay over a particular period of time. So how this works now is that you need to have a letter from your employer indicating that they have authorized you to work from home. And then you need to have the square meters of the full house, and then the square meters of the room that you're working in, so that you proportionate to, say, for example, if it's Wi-Fi, then you proportionate using those square meters to say the square meters per the room that you're working in over the total house area, which will give you the portion that is only attributable to the home office expenses. So let's say you're working from home, you can also qualify to have expenses, to have a home office expense, your home office expenses taken into account, but it's not the full amount, it's proportionated, and there are certain expenses that qualify to be home office expenses that will be taken into account. And also, if you're a commission earner, or if you're a sole trader, the business-related expenses, they are also deductible, because remember, as a sole proprietor, as I have indicated earlier, the amount of income that you receive is taxable in your individual capacity. So that is it on deduction and allowances. So now on filing your income tax return. So there are options that are available to file your income tax return. The income tax return can be filed electronically via e-filing, and you can also use paper-based filing, where you can walk in branch at a SARS, in one of the SARS branches, so that they can file your tax return for you. And then a point to note is that you should ensure that all your supporting documentation are available should SARS request additional supporting documentation. As I indicated, that if you have, let's say you have a refund, the burden of proof rests on the taxpayer if SARS requests for supporting documentation to submit those supporting documentation in the applicable timeframe before SARS closes that assessment and issues their own assessment based on the information that they could verify. And then for penalties, so late or incorrect filings can result in penalties or interest charges. So if you submit a late return, you will incur interest and penalties. And then should you incorrectly file a tax return knowingly, then it means that you'll be subject to interest and penalties. However, should a return be incorrect, you can request a correction, and then you file a new income tax return. But however, in that situation, SARS will request supporting documentation. As you have indicated that they have assessed, but you want to request a correction, SARS will request supporting documentation for the new assessment that we have opened. So in closing, we'll speak about tax planning. So we need to strategically structure your financial affairs so that you minimize on your tax liability. So legally reducing your tax burden through careful planning in compliance with tax laws, that is tax avoidance. What is illegal is tax evasion, because now you're trying to willingly falsify information and submit incorrect information from source. So with regards to tax planning, you should also consider consulting Brainmore Inc. with the tax professionals for guidance on tax planning, and also to get more insights on how best as an individual you can optimize and reduce the tax liability, and also different ways in which your tax liability can be reduced over a particular period of time. Okay, so I think that is my last slide. So do you need help filing your individual income tax or other tax types? Okay. Okay, all right. Okay, thank you. So in conclusion, understanding individual income tax is essential for South African citizens and residents to comply with the tax obligations and also minimize your tax liabilities. So this can be achieved by also ensuring that you have good record keeping and ensure that you receive all your certificates from your various third parties on time, so that as we submit or as you submit your tax return, all supporting documentation is supplied. And also SARS concludes the case on a quicker basis. So yeah, so that's it from my side with regards to individual tax.
You're muted, Tendai.
Oh, sorry about that. I was asking if there are any questions that we can answer with regards that individuals might have with regards to their taxes that we can assist with.
Okay, we do have some questions. There's one that is coming from Willie, which is asking, is SASSA taxable and where must it be reported on the taxable return?
Okay. I'll give the question to Miss Mullen. I think she's in the webinar. Let me just check.
Okay, we can just go to the next one whilst we are waiting for Ms. Marlin. There's another question again from Willie, which is asking about who is provisional taxpayers.
Okay, so basically we covered provisional tax in the last webinar, where we indicated that as a provisional taxpayer, if you earn income, I think it's kept at around 30. If you earn income other than remuneration that is greater than 35,000, then automatically you become a provisional taxpayer. So the difference between, let's say, a provisional taxpayer and someone who's not a provisional taxpayer is that a provisional taxpayer pays tax on a 6-monthly basis. That's like in August and then in February. But then a non-provisional...
These terrorist financing checks, or these checks that you're going to see in the next, when we get.
Okay, and then a non-provisional taxpayer would mean that you earn remuneration, and of your other income that you receive, it does not exceed 35,000, then you don't need to be paying tax on a 6-monthly basis like a provisional taxpayer. I hope I gave that in brief as I can, as brief as I can. Sorry?
Okay,
okay. Okay, sorry. To answer the first question, Mullen, there was a question asking about, can you please repeat the question?
The question
The first one was...
Is SASSA taxable and where must it be reported on the tax return?
Is SASSA? Can you repeat the question again?
Is SASSA taxable and where must it be reported on the tax return?
No, I'm not sure of the spelling for SASSA. What is SASSA? I can't get it. Maybe just get the detail, then we can get back to the person.
Yeah.
Is it a lump sum? What is SASSA?
I think it's the grant. Maybe we might just take note of the person and then we can. It must be the SASSA grant.
Okay, the grant. Yeah, maybe the person can elaborate.
Yes,
Is it
maybe
the grant income?
Yeah, there isn't anything much further there, so maybe we will just take down the details
Okay.
and then we'll
All right.
we'll
Okay, no,
have.
it's fine. Thank you.
And then I think there's an, oh, he said old age grant. And then okay, we'll go to there's Miss Lloyd. Is asking, are we not going to do an example on how to fill the tax return?
Oh, okay. So
Sorry,
I
can you
think
please
we
repeat? Oh, sorry. Okay.
okay, no, it's fine. You can take it up, Tende. You can take it. I think that one can be another webinar where we show you how to fill your tax return and stuff like that. But not today because of time. I think we are almost left with a few minutes into this, so it's difficult to put it all. But it can be another. We actually planning to have sort of but that is next year, a boot camp where we do those exercises so that we can empower people to be able to do some of the things on their own. So I think that can be another one where we show you where to put what and what does because SAS goes with the codes. So what does different code XX mean when you're doing your income tax return as an individual? So that can be arranged as another webinar.
Okay. And for the SASSA one, we'll have to contact you, but at the moment we can say no, the SASSA income is not taxable and does not need to be disclosed. But we will have to contact you, then we can have further engagements, Mr. Willie, since we are running out of time. Yeah.
Okay. Yeah, I think that's it from my side. I'll hand it over to Kuta.
We have to look out for our next webinar that is coming on the 6th of September, which is on tax savings, which is a free webinar. So you are welcome to join us again. And then we also have another one, which is going to be there on the 20th of September, which is on understanding financial statements. And this is how you can reach us. You can connect with us on our number. You can take down the details, as well as our email address. And we also have our websites where you can also find us there, as well as our location. We are in Midrand. You can also visit our offices, and we also do have our YouTube channel where you can watch more videos on our tax services and all the other services that we provide as Brand More. And you're welcome to go there and click. Once again, we want to say thank you very much for joining us, and hope you got helpful tips from this presentation. Thank you so much.